It's very important for founders to not drink your own Kool-Aid, number one, if you're like making this definitional debate. But two is, I think if you're a smart VC, then you should be having a very fair conversation about what the right margins and right metrics to track and to work at a board level with. And then by nature, if you are a good VC, then you should be working with good founders, and good founders should want to work with good VCs. So in general, I think having a good faith attempt of looking at the right metrics means that you're more likely to hang out with the right board member. Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, serial founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 40,000 members and get transcripts, resources, and community at www.bravesea.com. Stay well and stay brave. Evo Commerce sells premium affordable supplements and personal care electronics, operating in Singapore, Malaysia, and Hong Kong. Strive brand sells salon-grade quality products for home use and using direct-to-consumer channels through its online retail channels and physical shops. BBAC is the leader in hangover remedies in over 2,000 retail outlets across the region. Learn more at bbac.co and stryv.co.
Morning, Jeremy. Glad you just swallowed your sweet whole in a lie.
I know, right? I didn't want to treat the audience to the whole sound of me kind of like gulping down my food and breakfast.
Yeah, but I guess at some point we should do like a mukbang episode of us just eating and staring into the camera.
This is like what every VC's dream, right? Is I'm good for everything and people will watch me do a mukbang. Hey, you know what? This is the differentiator, right? So you could be like, I'm Anderson Horowitz and I'm known for mukbangs. Yeah.
It might not be a bad idea given that there are so many like F&B startups in Southeast Asia anyways.
The other way of doing it would be like if you're a famous eater, competitive eater like Joey Chestnut or that, the Japanese guy.
Yeah.
And then you became like Kim Kardashian, right? You become like an investor.
Yeah.
But instead of Kim Kardashian doing cosmetics and makeup, now you're doing consumer food. I think it'd be great. You know what? A lot of people will take your money. Right? Think about it. You're like a competitive eater. Yeah. And you're like, oh, I'm your investor. And then you put your face on the front. Those cutouts. I endorse this place. So next thing, a Michelin star.
Endorse all my favorite ice cream and coffee brands out there in Southeast
Asia. Yeah. You know what? This is actually not a bad idea. Well, today we wanted to talk about an episode because we saw some news and we're just reminded of all the stuff we've seen before. So today is our favorite list, which is like a list of all the fraud and accounting tricks and shenanigans that we've seen. And I think we share about it in 2 ways, right? I think one of us is please don't do it. That's number one. Rather than taking it as a list of what to do. And of course, I think there's a lot of VCs out there in the ecosystem who are not aware of them. And then they tend to run straight into a blender. They don't detect it. And then their careers are destroyed because they accidentally invested in a fraud company. And I was like, you didn't do your due diligence. And you're like, yeah, because you only had 2 years of experience in VC and nobody talked about it. So I think this is what our community gift to the community based on all the stuff that we've seen together on the shenanigans. So I'll just kind of like start off first. I think the easiest one and that we had to do a lot of math on was the definition of gross margin. So that's a very common trick. I think we saw that at Uber. We saw that at Grab in the early days. We saw that at like the Rocket Internet affiliated companies, which is as a legal accounting definition, which is basically saying we have a definition of gross margin. Then they have contribution margin, which normally means gross margin minus some indirect costs. Of course, I think what's special is that now we have CM1, CM2, CM3, CM4. And I think that's the fun definition that we have. In the interest of our professional code, we're also not going to mention any names because there are claims in the news about certain names. It's just that I think it's just something for you to be aware of and so that we can do less work fighting off people. So I'll start off first. So the easiest one that we often see a lot of debate about is the difference between GMV as well as revenue. So we see a lot of companies which are looking at GMV, which is gross merchandise value, which is I think the volume of throughput and transactions on a platform versus revenue. And the reason why it's important is because let's say you're an e-commerce platform and you run $1,000 of transactions, but you only collect 1% as your platform revenue. You could either say it's $1,000 GMV or you can say it's $1,000 revenue, and there's a big difference. And I think we've seen a lot of that where a lot of VCs or lead VCs seem to be very confused and they give these multiples, which maybe are reasonable if you take GMV to price of the company, maybe like 10x or 20x. But it doesn't seem to make sense when it's looking at the platform revenue.
Yeah, and I think that's important because if I know the VCs out there are pricing my company on GMV or let's say 1x GMV, then I just give Black Friday, Blue Monday, Gold Wednesday sort of like discounts. I run sales every day and that drives up my GMV massive. But the net revenue, I guess, is much, much lower because you think about what actual revenue you're making post discount, subsidies, all the stuff that you collect back. I'm sure Jeremy has seen a lot of Amazon packages around his house and being shipped back as well.
Yeah, no comment on not myself, it's a household purchase. But yeah, I think the tricky part is that I don't think it's fraud. It's just an accounting definition for that. And I think that a lot of new VCs kind of like take that revenue point of view and get confused. And what happens as a result is that the startups may end up getting, like you said, focused on the wrong metric. And in terms of accounting, the difference between GMV and like platform revenue, of course, is your, like you said, any kind of like promotions, discounts, driving up the volume of transactions rather than driving up the profitability. I would say barely profitability, but at least the revenue take of the transaction. And I think we see a lot of that in Southeast Asia, especially because I think in the US, there's a lot of SaaS, a lot of like very companies that are very much more technology oriented. Cybersecurity is hard to, there's no such thing as GMV in cybersecurity. I think in Southeast Asia, we see a lot of transactions. We see a lot of fintech companies that are taking some percentage of it. So I think there's something to be aware of so that you're not fighting over the wrong definition. Quickly to the second one, I think is if you're a fintech company, net interest margin versus gross margin is something that we often see, which is a bit more specialized. But basically what this means is that just because I lend you money and you pay me back $10 doesn't mean that's my margin, because I actually have to pay interest for the debt, the capital that I'm borrowing. And so a lot of fintech companies skip that step and just look at it as gross margin. I think we've seen that a few times now. And it's always, I think what happens is that people end up valuing the overall repayment flow, but they don't understand the cost of capital as one of the cost of goods sold for that repayment flow. And so they wrongly classify that revenue.
Yeah, no, I think this whole idea about net interest margin probably only made more sense because when the interest rate environment changed, suddenly your margin profile for lending becomes very different, right? So looking at net interest margin becomes very important. I think also in the context of Southeast Asia, where your non-performing loans rate can be quite high in an emerging market, where collections is tough or run away with the money. And Indonesia has 100 plus islands. How are you going to find that little bugger who ran away? Looking at the NPL rates as a cost or factoring that in how you sort of calculate your net interest margin and just looking what is this lending company's actual net interest margin rather than how much top line revenue they're making from overall loan repayments. I think it's a much more holistic way of looking at the health of that lending.
So that reminds me of another error that often happens is that a company right now are trying to be all in one for this, right? So they'll say like the super app for this. And so the revenue may have multiple revenue streams, right? So there's a one-off revenue, then there's like the, let's say GMV revenue versus the actual platform revenue versus the kind of, they're also lending to those same players as well. And so those are three different revenue streams and they bundle together, say revenue. But those are three very different types of quality of revenue, right? Because one is one-off and not recurring. One is GMV, not actual platform revenue. And the other one doesn't include the interest rates and so on and so forth. So then people get very excited because they're like, wow, that's $5 million of revenue. When actually in actuality, maybe it's only like $1 million of actually high quality recurring revenue. So I think that's another one.
That's such a smart one. I think of that if I ever start a company. I'm
kidding. You set up like a char siu roast pork rice stall and you're like, every time I sell one dish of rice, it's a recurring revenue stream. That's one. And then I have a buy now, pay later where you buy your rice dish and then you sell some like shoes on the side and then you collect wholesale price. Yeah.
And then I'll make sure to start a website for this char siu shop and ask VC for a tech multiple.
Oh yeah. Okay. That's another one. Okay. So another one that we often seen is not using the right multiples. And I think in general, we all understand technology multiples to be higher. And I think we obviously generally understand that services revenues tend to be, multiples should be lower. And I think the big difference that we have here is people get messed up. So what I mean by that is For a startup, normally a multiple is high because you're growing very quickly and because you believe that the market size will get larger. So you're front loading some of that CapEx investment because they're going to grow into that valuation. But thirdly, of course, we should have an eye on what their end state is going to be. And for early stage companies, obviously that matters less because we're further away. So this is maybe more relevant for like when you hit the C, the Series A, the multiples, right? Because maybe for your startup may have no revenue in the first 1, 2, 3 years. But I think where we end up is we end up in a scenario where in Southeast Asia, there are many logistics companies that seem to have a technology multiple. And then there's a big debate, which is that they shouldn't have it because the quality of revenue is different in terms of the recurring nature. That's one. But two, also in terms of the profit ratio of that revenue as well. So I think we see that as well for agri-tech as well. What else have you seen?
Tech's a big one. As consumers, always conflation of like multiple revenue streams, right? Plus, you might have a consumer SaaS, but you also have something that is like moving goods through your platform, and then there might be a payment revenue stream embedded there somewhere. And each one of them have very different margin profiles and also very different quality of revenue.
So that's a totally fair debate to have. I mean, often you see founders debating one valuation multiple versus the VC. And even within the VC committee, there could be people arguing it's a high multiple, low multiple. But it's important because I think if you have too high a multiple, especially when it's inflated by zero interest rate policy era, public markets are crazy, then people end up making some bad decisions about that. And you set your startup up for a future flat round or down round if that doesn't combine with the other areas we talked about. So again, imagine you have a GMV multiple of 20x versus one round later, people are looking at it in terms of your revenue times a 5x. Then there is like a huge difference, right? But imagine the scenario, which we see often in Southeast Asia, is that we may see an e-commerce company where the valuation is a function of their total GMV times, let's say, a 20x technology multiple. However, in the next round, the VC takes the revenue, which is 10%, let's just say, of the GMV. So it's a 10x smaller. And then they only put on, let's say, a 5x multiple, right? And so if you look at the math, then there's actually quite a dramatic slope difference because it becomes 10 times 4 is like a 40x difference in basically the valuation. So I think you see a lot of pain. And then the founders, obviously, it's not really their fault because they're like, great, I got a great valuation at the start. And then no one's going to complain at that round. And then the next round, they're like, wait, why am I talking to founders and VCs who are very cynical about my valuation? And there's a big fight and debate of the board.
I mean, that's interesting because it reminds me of one of our portfolio companies. I shall not name who, but obviously they didn't go and talk to as many VCs as possible. And in the end, it was like 3 funds that were offering them term sheets, right? And basically there was some level of like collusion between the different funds to sort of like offer term sheets at similar valuations, which is actually, I guess, a good thing for the VCs issuing the term sheets because they sort of control the price and valuations a fair bit. But from a founder perspective, it was probably like suboptimal in terms of sort of the dilution that they now have to manage and on top of the capital requirements that they want to have to grow the business.
Yeah. Key thing here and my quick advice to founders is don't share who else is the potential lead VC or competitor with your other potential lead VC candidates or even your follow VC candidates because it's like round trips. So I think that's my advice to you. Otherwise, you remove the competition era of your auction and then it moves into quite valid. Is if the two VCs already know each other, they'll rather come in together because they're like, hey, we're buddies. We can be co-lead VCs on this round as well. So there's other types of accounting definitions. The other one is gross margin versus CM1, CM2, CM3, CM4. So for those who are not accounting trained, it basically means gross margin versus a contribution margin 1, contribution margin 2, contribution 3. And what it's supposed to be is that gross margin is supposed to be your direct revenue minus the direct cost of goods sold. And then contribution margin is supposed to be minus off some of the variable and indirect costs that you believe reflect. And then after deducting this is the amount of value that accrues to your company's fixed costs as a whole. But I think what that means in practice, of course, is that, for example, when you go back to the e-commerce, is that you have GMV where you're making $1,000 of volume transactions. You collect 1% as your revenue. So you're making $10 as your, sorry, let me say that again. So let's use a scenario where it comes all together, right? So let's say you have an e-commerce company and you have $1,000 of transactions on it, and you take about 1% as a take rate. Now, there's a big fight debate now, which is we know that GMV is 1,000, but of course, whether we say revenue, I would argue that this would be $10. Your revenue is $10. And then obviously the gross margin could be your direct, and this is where the debate comes in, but you could say logistics or credit card fees or other stuff that's fundamental to the cost of business of running this transaction on a one-to-one basis. And I think people start fighting very aggressively because they want to move like credit card fees or logistics and shipping fees to CM2, CM3, CM4, because what they want to say is, hey, as a founder, they want to make arguments like, oh, GMV is 1,000, our revenue is 1,000, our gross margin is 900, our CM1 is 800, my CM2 is 700, and my CM3, CM4 is finally like $5, right? So they're trying to do the same math, but move as much of that cost down into CM4. And the argument again is they're trying to get the VC to give them a good CM1 to valuation multiple.
I mean, I think there are many reasons why I guess founders would use all these varying levels of CM. I mean, one could just be really trying to be like granular about understanding what the state of their contribution margin is. And I guess that's good, right? Because then you know at which part of the contribution margin you actually need to fix. But I think there are probably also some folks out there who are just maybe a bit avoidant of the reality of the business, where in some businesses, it would be very, very tough for them to even hit CM4 break even. And so they just try to split everything up and say, okay, we are CM1 and 2 positive. After this round, we can maybe hit CM3 and 4 positive. But after this round, that obviously does not happen. And all sorts of companies, especially the marketplaces, have blown up with this sort of avoidance of the reality of the contribution margin of the type of businesses that they run.
And I think that's the sad part, which is that obviously companies don't want to blow up, but because I always tell us you're driving a car and then you're trying to convince someone that you're driving faster than you actually are, and that your gas tank has more gas than it actually does. There's a other person's like, oh, okay, looks good to you because it's that. But then you end up believing those numbers and then you end up kind of like driving a car off a cliff. So I think it's very important for founders to not drink your own Kool-Aid, number one, if you're like making this definitional debate. But two is, I think if you're a smart VC, then you should be having a very fair conversation about what the right margins and right metrics to track and to work at a board level with. And then by nature, if you are a good VC, then you should be working with good founders, and good founders should want to work with good VCs. So in general, I think having a good faith attempt of looking at the right metrics means that you're more likely to hang out with the right board member because there's adverse selection, right? Which is that if you're giving the wrong numbers, only the bad VCs are the foolish ones, or the ones who are intentionally running with those metrics tend to want to continue to invest in you. So I think it's a big problem. I think a corollary as well to that problem is, I think a lot of startups that maybe have a heavier requirement, so they require, for example, account personnel to be on the ground. That cost, they may make it part of their fixed cost rather than being part of their contribution margin, right? So I think we've seen stories like they had to have one person on the ground at every account. And I think there's a difference, because if you're having a salesperson that just buys the transaction and then at each place and then maybe does a few refresher calls to remind them to pay, that feels like relatively light. But when you have somebody who's basically acting as their arms and legs, you're effectively just running a service on their behalf. It should be part of the margin or cost structure for it being done. So I think that's the craziest we've ever seen, one person at every shop helping them run transactions. And obviously they were way less profitable than they showed it to be, because they put those people as like a line item called HQ salaries. And you're like, why is this? And it's actually not that large as well, because even in Indonesia, the salaries are not that high, but it actually is quite meaningful.
Yeah, so I think, at the end of the day, we all just need to be clear about what is the actual cost of running this business and generating this sale, and factor that into the contribution margin, right? What I think is adjacent to this topic about margins is maybe your margins aren't that bad, and maybe the margins are bad because someone's taking a kickback.
Oh.
Yeah.
We've seen multiple versions of that.
Yeah, I've heard stories of new company CEOs coming in, and then they're like, why is the company so negative in EBITDA over the last 4 years when this is an industry where the margins are supposed to be relatively healthy. And then he goes line by line, he visits the operations of the company, and then he just realizes there are just so many kickbacks happening at all sorts of transactions, right? It can be as simple as equipment buying, could be as simple as rental of certain locations. What sort of B2B kickbacks do you think both investors and founders think about?
Yeah. I think the sad reality is bribery exists in Southeast Asia and other emerging markets. And so I think people really have to be aware it happens. I think there are different types and it just shows up at different levels, right? I think I would look at it in terms of the supply side, the demand side, and maybe even the founder side. I think the easy one that we often think about is the demand side. So people are often trying to fight for contracts and trying to win business. And then the guy says, hey, I want some cash dynamic. And I think the legal version of that I think we've seen is like promotions as well as cashback. It can make sense in the scenarios, for example, where the guy is like doing $100,000 transactions for year one, you want to give him a 20,000 cashback just to make sure that he's really stuck and embedded in your platform and runs this transaction. So I think as long as you like legally define it and make it clear, and in a perfect world, it will be like gross revenue minus kind of like this cashback program equals net revenue. That's where it should be recognized. I think where it gets very tricky is when two reasons. One, when it is not recognized, in other words, effectively is bribery, but then they hide it somewhere else under like marketing or sales expense or some random place. So that's not okay. I think the other version is when they do it because they inflate the invoice. So the amount of transaction is correct in terms of the net profitability to the company, but they inflate the invoice. That's another version. I think the third one, which is like very gray area, and I would not recommend it, but I think we often see like many startups put that cashback program and they move it under marketing and expense or sales expense. And so I think more naive VC will be like, wow, your revenue is growing really like nicely. But then they see a marketing and sales expenses going up quickly as well. And they're like, okay, that's fine. But they kind of like get excited about the top line numbers. So I think that's one version of it.
Yeah, different friends have shared with me about this interesting case of how even things like financial due diligence reports might not always be true. Like they were very close to closing out a transaction, and then, one of the partners was like, hey, can you help me understand this like FDD report? And then the person who made the FDD report was like, actually, these are not the numbers that I signed off on. And then it became a can of worms, right? And they started to do spot checks in different locations, and then they realized that certain locations did not exist. And I guess that's particularly challenging for VCs diligencing companies which have very large physical operations, numerous on-the-ground, say, stores, warehouses, locations, outlets, etc. And just figuring out how to do that scalably, because it's going to be very hard to check off. If, let's say, a company has 100 plus locations, it's going to be very hard to check off one by one, all 100 exist and have real sales and revenue. Or even another investor friend was telling me, right, that she was in Vietnam and like she went to the company's office for due diligence chat, felt normal, okay. But then on the last day of her trip, she decided to just make a surprise visit back to the company's office. And then she realized that company did not exist.
What?
And the office was fake. It was like all this like shenanigans that you just have to do the unexpected things when you're doing like your due diligence to figure out if there are things that you're not catching.
What that reminds me is that VCs can have a reputation for due diligence. And in terms of maybe the length, how many months, like 3 months of due diligence versus 1 month, how intense the due diligence is. And I think it's important for a VC to have a reputation that you do your due diligence. And obviously in the hot era, I think everybody was like, wow, these VCs are really slow. And I think it's true because it's slower in terms of whatever it is. But I think what I'm trying to say here is that if you have a VC where your reputation is that you do very fast DD and you're very fast to wire money, that's actually probably adverse selection. You can't have more of these fraudulent startups start to approach those they know that does less DD. And that's really important because you end up becoming like a prime target as a VC. Like you become a money pinata. It's like where the founders were like, yeah, it's okay, these guys do less DD, so it's more likely for me to do well. So I'm going to spend more time pitching them and closing on them rather than the VC that does more DD. So I think it's important to have that reputation that you do your due diligence. And it shouldn't be seen as a negative thing. Obviously, don't take too long. Don't take 4 months, 5 months, 6 months. But I think it's okay for you to be like, hey, if we detect fraud, we are going to pull out of the final stages of this post-term sheet pre-wire process. And we're not going to make a big deal about it. But the moment you do this kind of stuff, then people know, okay, you actually are willing to stand up for yourself. I think another one that's interesting is there are startups in industries where kickbacks and bribery is common. And so the startup struggles to recognize how to do that. So they're quite upfront with that with the VC investors. And then you're just kind of like, that's hard to do accounting on. And that shows up in different places. But it's interesting, right? Because they're quite direct with the board about it when they talk around it. And then, I mean, my general point of view is as a VC is just don't do the deal because it's too complicated. And eventually, if you do a Series B, Series C, like growth investor, like all those numbers have to come up to the books if you go public as well. So actually, I think it's quite hard to do that kind of deal. But I think we've definitely seen that where it's like the behavioral norm, but then the founder is direct about it with their internal stakeholders, which is quite interesting twist on it.
Yeah, and I guess it's a function of how the investors feel about underwriting such expenses, which I guess really varies based on, I guess, maybe ESG practices, who your LPs are as well, right? Those definitely play into the sort of decision making on such deals. I think the other interesting one actually from a sort of, I guess, P&L margin perspective would be things like salaries. We briefly talked about how some salaries should be recognized under, your sales and marketing expense, contribution margin accounting. But, someone was telling me this recently, right? There was a certain company that hasn't paid employees in 8 months, but, they have been paying their founders super high salaries. So it almost feels like all the investment raised is just to pay founders and not anyone else in the company. So I think maybe that's also something to look out for and think about, like high founder salaries and whether they're actually paying like the people that they need to pay to run the business. I've also heard of like companies giving very high severance pays, like 1 or 2 years worth of severance salaries. And these are to people that the founder is related to, right? I think controls for such large amounts of salaries should also be put in place by the board. But I guess at the end of the day, if you're a VC with a large portfolio, it becomes very hard to maintain relationships with the employees of your portfolio companies beyond the founders and maybe some people within the C-suite. So I think that's also an area that probably investors should actively think about as they go about making investments, portfolio managing.
Yeah. So I think that touches on something that we think about, which is, and I think a potential risk factor is if members of the executive team are related to each other. So I think we've seen that. So that could be in a form of siblings, or it could be in a sense of like brother-in-law, sister-in-law, or husband and wife teams. I think the US is normally seen pretty negatively because they want to see professional talent and everything. I think in Southeast Asia is a bit more common to see this kind of relationship because I think talent density is scarce. In Southeast Asia, you probably birds of a feather flock together in terms of like family or blood or spouses. So I think it's quite common for husband and wife teams. So I think that in itself is not a problem because as long as you work together and you're both professionals, okay. I think the soft concern is that, hey, if the two people conflict, can they actually be a high-performing team? And do other members on the executive team feel like they can voice disagreement or strategy? Because maybe they conflict with the husband, the wife is the CEO, and then can the wife choose fairly between the professional executive versus the husband, right? So if they end up favoring their husband's opinion more, then that could be a net negative for the company's performance. But that's a soft concern. I think the hard concern is that I think we've seen scenarios where executive teams end up either conducting some version of fraud or shenanigans because they valued each other's relationship and trust each other more than the company. So they don't feel like they'll get caught. And so we've seen different versions of that. Like, for example, I think a good company should have dual key. That means in a sense, in order for money to transfer, it requires 2 people to sign off. And if those 2 officers are both blood related or equivalent related, then you can end up in a scenario where money that's supposed to stay with the company can end up being transferred to other places, right? So I think there's something to be aware of. I think there's also another case I've seen was like a CFO was blood related effectively. And then basically there was shenanigans at the overall reporting level, which had to be caught through due diligence as well. So I think there's something to be aware of obviously, I think if there's a blood relation, but that person is very junior, like a product manager or a logistics manager, it doesn't really matter as much. But when that person is a CFO especially, or something, I think that can be a concern.
Yeah. I think it's very important for the institutional investors to sort of control the hiring of key executive members. Like CFO is definitely something that I think investors should sort of drive and appoint rather than it being some random person that the company decides to hire or has a very good relationship with, right? Because I think you want that sort of like independence, neutrality. And of course, people often usually see the CFO departure as a sign that a company is not doing too well with how they're managing money, both professionally, but also on a sort of maybe personal level. So yeah, that's probably a thing to watch out for as well.
Yeah, I think if you open up the news and they depart around the 1 year mark or earlier, then there's always a very bad signal because
Or a 1 month mark.
I think we see that, but so I think you just have to do that due diligence just to make sure that, because it's a very, now it could be because they were not a good fit, but you really just have to make sure that you understand why it actually happened. I think we've seen that happen multiple times now in the news, because normally they get announced very happily as, oh, we hired this great CFO of this caliber, and then after that, they just disappear silently on LinkedIn. So I think there's something to watch out for. I think also other types of flat out fraud would be like a flat out transfer of money to the founder's accounts, right? I think we've seen that before. So I think we've seen scenarios of, executives transferring money to themselves and then they run off.
Yep.
There's one. I think founders have transferred money to the personal account and they're like, I was holding it on behalf of the company, but it was never approved by the board or other people. So there's another version of that. I think we've seen people do it via the blockchain, which is the worst version of it, because
decentralization.
But it's like, hey, it's a public ledger, right? So everybody can tell and see it when it happens. So it's really hard to explain. So I think we've seen that as well. All kinds of crazy shit, right? I think I would say that there is a legal version of this, and that happens in America, which is, as a founders, you're drawing a very low salary, you're primarily equity based, and you want to buy a house to live in San Francisco. So what you can go is you can go to the board and get approval for either high salary, or you get approval for a company guaranteed loan. And so basically it's a housing loan, but to some extent the company is helping support it either through a loan directly for the down payment or company guarantee. And that's a way to unlock some cash in San Francisco. But I think what I'm trying to say here is that in Southeast Asia, it does require to be approved by the board. And if it's not approved by the board, or if you hear the founder buys a very, very nice house all of a sudden, then I think question marks should pop up. Just be like, why is it happening?
No, I mean, I'm sure we have all heard cases of certain companies where even customer payments are flowing through the personal bank accounts of the founders, executives. I mean, I guess that one is more like, if you're a company or a customer, then I think there's some level of due diligence or you should also do when you're making payments to like personal bank accounts instead of a company bank account.
Another version of that is cash payments being flowed into and consolidated at hubs, bank accounts. So what I mean by that is there's a lot of cash transactions that are floating at layer 1, layer 2, which is like supposedly like with the, let's just say, X player, then you have a hub, and then all that is being reconciled at some level, and then it gets transferred into your electronic bank accounts one level down, right? Maybe at a daily or weekly or monthly level. And the reason why there's a big problem is that from here onwards, the electronic level onwards is clean, or at least in terms of cleaner, or at least clean enough to at least understand the individual transactions. But I think we've seen concerns where if it's all cash, especially in Southeast Asia as an emerging market, then there's a high potential for fake invoices to be generated. So for example, hey, at the end of this week, $100 was transferred to the bank account. Okay, that's fair. And then maybe the actual number of invoices that you did was actually like 1,000 of sales, and then you had $900 of transactional costs. So you only transfer $100. But there's a concern that invoices, what you could do, you could have made it into $100,000 of invoices, fake invoices, and then you have $999,900 of COGS, right, at that level. And then the amount they transfer to your bank account is still the same, which is $100. But one is like you have a much higher top line, and the other one is like you just have your normal top line growth. So I think there's been another piece is that as a VC, if you're seeing that cash is reconciled only at a certain stage or certain tempo, you have to be aware that there's a potential for invoices to be faked or fraudulent at that stage here.
I mean, I think it's especially a big challenge for emerging markets where payments hasn't been fully digitized yet. I think in the US or the developed markets, people just assume that financial statements or revenue margins are true just because they're sort of traceable to electronic payment by whether it's a B2B customer or B2C customer. The other thing I was thinking about the other day is, if you actually raised a couple $100,000, you could just use that couple $100,000 to artificially drive your sales and then go to the VCs and be like, look at my hyper growth. Do you want to give me my next round? And then you just pay yourself back, right? After that new round is raised. So I think just having a more granular sense of the data and like actually talking to customers to understand like why they're actually using or buying a product or service. Yeah, super important for
I think in Southeast Asia, I think there's a lot of second generation, third generation children of wealthy families who are using those as a source of strength and leverage. And it is what it is. So I think that if that's what you need to do in order to close a transaction or to launch a fintech company or tech startup, let it be. But I think it's important for any related party transactions to be flagged and disclosed to investors. I think where it gets tricky is that maybe it's like a one-off transaction or so on and so forth. So I think there are different versions of that. But, if somebody's company is buying stuff from you and you don't disclose it, that's not good. I think the other version that we've seen more in China so far, it is a little bit more sophisticated and also a little bit more complicated because it requires you to be second or third generation, is where you offload costs into a shell company or into your parent's company. So for example, you have $1 million of top line, and then all your other competitors have $200,000 of SG&A, right? Headcount. Then you only need 50,000 of headcount. I think that a VC should poke and make sure you understand why they're so much more efficient compared to their peers. I think don't take it at face value as, wow, these guys are so efficient. I think you should just make sure that you check, did they move $150,000 of headcount expense into a shell company, a separate entity that's not visible to you? Or is it at a company that they control, maybe in a previous company they ran or in a family relatives company?
No, I think that's interesting, right? Because you could almost make a margin on your hiring expense.
Yeah, exactly, right?
It's like your pseudo HR recruiting firm or EOR.
Yeah, exactly. And I think one of the ways that the Chinese people have caught it is they give a public disclosure like, hey, with this number of employees, because people like disclose very large numbers, right? Like 1,000, 5,000. But then if you look at your financial count and then you're like, okay, actually the actual number is closer to 500. Then you just have that question mark. It's like, what's the difference? Is it contractors? Is it whatever? So you just have to be, I think that's one way of due diligence as well. I think another example we've seen of emerging market founders is that as a company, they've chosen to outsource something, right? The IT or some vendor, which makes sense. But then, of course, it turns out that entity is actually controlled by them or relative or something very close to that. And so what happens, of course, is you could make it the arguable case that if that was the best vendor out of 3 quotes or 10 quotes, you could make the argument that that's the best way to do it. But I think what the concern is, and I think what has ended up being a case, is that because you're related to that vendor, then you end up in a situation where the invoice is inflated and it's delivering substandard work, right? And so basically you're collecting a percentage for the vendor, the managing and executive. So this is like a pretty standard procurement fraud, I would say, that happens. If it's disclosed, I think it's a little bit easier to kind of like, as a VC, to be like, is this the best possible vendor? Which potentially be. But I think when it's not disclosed, it's normally a pretty red flag. Yeah.
Okay, so maybe just to wrap up, I think we have covered a lot of ground today, right? We started off talking through accounting definitions, confusions around GMV, net revenue, gross margin, CM 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. The lesson there, I guess, is really just be clear about what the actual cost of the revenue transaction is, both from cost of goods, but also the sales and marketing costs involved to generate that revenue. In the B2B space, I guess there's a lot more opportunity for fraud to happen, especially when you have like large scale operations, and it's just hard to check off one by one. Sales and marketing expenses, bribery, gifts, question mark, probably good to talk through with companies that you are sort of evaluating. You mentioned, I think, high founder or abnormal founder salaries, executive salaries as well. And then I guess related party transactions, is it from certain relatives, people, like how sort of sustainable, reliable are those related party transactions over the longer term, especially as an investor, you're trying to underwrite longer term growth. I think obviously financial controls, right? So I think having a CFO appointed by the institutional investor is important to ensure that you don't have outright money wiring from company account to personal bank account or vice versa. Cash transactions being reconciled before putting it into the bank account. Probably hard to confirm the source of funds and all that as well. And then, of course, I think finally we talked about how people are able to sort of pay themselves in indirect ways by through vendor contracts that they're hiring software engineers or even rent, and then it ends up going back into the founder's personal account. Super interesting long list of potential ways a company in emerging market could commit fraud. But I guess the lesson here for me, I think it's more about just being more watchful and having a closer eye rather than assuming everyone has like bad intentions or is out there to commit fraud. I think we just need to have more like open conversations about this. I think also is if everyone in a society knows that these are ways that fraud can be committed, I think people are just less inclined and keen to do it because the risk of getting caught is probably a lot higher when people are talking more openly about it.
Adriel and I will catch you. We see too much. Now, I think you listen to this podcast, you're like, shit, I can't raise money from them. They already know what's happening.
Oh, yeah. That's great. That's great. We should put out more posts about potential fraud so that people like go through the list. Like, you don't pitch to them.
You put like a poster of you cut out size, life size, that is like Adriel at a laptop. We can do Excel. No, I think, sorry, you just reminded me the last type is the founder is not who they are, which is the most direct. The minor version is they didn't go to the university, Ivy League, or I think we've seen certain founders have been publicly named because they're like, you didn't actually graduate from a university, that's one. But of course, we've actually seen cases where the guy is like literally like a fraud. So make sure you do those background checks. But anyway, the key point, other than throwing that bonus piece is, I agree with you. Please take this as a list of things to not do. And of course, it's a big range, right? Because some of it's fraudulent, some of it is gray area, and some of it is basically like accounting debates. But I think at the end of the day, over the course of 10 years, you want to build real company value. And I think the biggest concern I normally find is that I often see that founders who do this because they make it like a small lie at front because they feel like that's what's needed or because my peers are doing it. But I think it really often snowballs out of control because the problem is that once you start doing it, you can't unwind one of these accounting definitional problems, right? It's just hard to like suddenly reset your board meeting and just be like, okay, let's go back to the proper way of accounting. Like it doesn't happen, and the problem snowballs, and then it gets worse, and then you destroy your reputation when it gets exposed eventually, because eventually VCs that are more sophisticated will eventually join around. And I think it's important for people to be thoughtful about that. On that note, let's peace out and save it for the next time. All right.
Awesome. Great chatting, Jeremy.
Yeah. Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.